Talk to us about the change we've seen, because there has been a lot. If you look back to where we were January 1 of this year, where we are now, it's really different. For example, from 0 to 3.75%, even higher than that, 4.25% on the Fed.
Pretty incredible. Actually, when you go through, I've been doing this almost 36 years, and you say, what were the years that you had this sort of change? 2008, maybe still the biggest, but this ranks right up there at the top. You think about, we came into the year in March. The Fed was still doing QE and had the funds rate at 0, and now we've priced the funds rate at about 5 as a terminal. That's pretty extraordinary, and a year that you've never seen, nobody's ever seen, even in my long tenure in the industry, where the bond market and the stock market all traded down. So your hedges, how you did portfolio allocation, change of leadership in the UK and all of the pension system dynamic, a war that, who thought that we'd go through a deglobalization process and the impact that has on inflation, impact on fuel costs, food costs. This is extraordinary.
And that's before you get to China.
And by the way, I didn't even think about that. And the emergence from COVID, not emergence from COVID. Now do we start to grow? It is pretty extraordinary. It felt like 5 years wrapped into one.
So the economy has absorbed a surprising amount, actually, if you think about what's happened here. Can it absorb what's going on right now? What are your prospects for as the so-called soft landing at this point?
So, David, I think people underestimate how flexible, adaptive, innovative, particularly the U.S. economy is. Harder in emerging markets. You saw a year where the dollar appreciated, emerging markets come under stress. But I think people underestimate how darn flexible, and you're seeing it play out in the U.S. economy. Think about when we emerged from COVID, all of a sudden people needed a TV, electronics, furniture, massive goods grow, and you saw jobs moving in the goods sector. Then people had already gotten what they needed to get. They didn't need another computer or TV. Now you shift to the service sector, growth from the service sector, and you're seeing jobs, leisure, restaurants, hospitality, healthcare that are now starting. It's pretty extraordinary. So can the economy withstand this? Listen, this is a historic move up in interest rates, tightening of liquidity through the balance sheet channel. But yes, I think, we've talked about on your show, I just don't know why soft landing is like landing the plane on a pin needle. You have an economy, you have a savings rate that's still in good shape. Leverage in the system, I've gone through 2002, 2008, where you had too much leverage in the financial system, consumers, corporates. Leverage is in pretty good shape. So the economy has a series of buffers alongside of it. Listen, the economy's slowing. Could we have a shallow recession? For sure. But I think people underestimate a developed economy, particularly like the U.S., is much more reflexive than people give credit to.
Rick, you said the economy's resilient. How resilient are the markets? Because you mentioned one of the issues that we've talked about before, which is liquidity. A lot of liquidity coming out of the markets. Have the markets held up? Are they prepared for what comes next?
So I'd say the markets are less adaptive and flexible. And I've learned over my career, there's a cultural dynamic around markets. People don't like to lose money, but of course they don't like to lose money, but it's not symmetric to making money. I've always found this, markets go down 5 times faster than they go up. People like to protect what they've made and don't like to lose money. And when people think the prospects that they could lose more money, markets go down even faster. And it's pretty extraordinary. We witness that. And I've always found that people buy on up markets and sell on down markets because they just can't take the losing more money. Now, we're at a place today that if the Fed starts to come off the boil, which I think is the case, that now we're talking about rate volatility on the risk-free rate on interest rates, that's going to come down a lot. That gives, there are 2 components, particularly in fixed income, and any assets, the risk-free rate plus your risky rate. And we always think about whether it's debt, equity, where's my risk-free rate and where's my risky rate? But if your risk-free rate is moving all over the place and moving higher, you can't value any financial asset. If that stabilizes, risk premia, term premia comes down, and I think that's a really big deal. But are we going to have some vol into next year? Yes. I just think less than 22 if the Fed pauses. And by the way, the ECB starts to tone it back, Bank of England, et cetera.
Well, you talk about the Fed coming off the boil. It looks like at least they're going to slow down the rate of increases. I'm not sure they're going to cut right away, but slow down the rate of increases. What do the economic numbers show us about that? Because we did get CPI numbers out this week that a lot of people reacted to very favorably.
So it's really encouraging. By the way, we've had head fakes before. We had it in the summer. It would look like, okay, we're on the back side of it, and then all of a sudden it popped up again. I don't think it's over around what is elevated rates of inflation. You see it through wage stresses in the system. That being said, when we break down the component parts of inflation, you think about shelter, you think about food costs, used cars, supply chain, freight costs, they're all coming down. So you take some comfort in that we're on the backside of the elevated inflation. we've run some numbers that even if inflation in most products stays elevated 4 to 5%, because of where energy is today, because of how much it's come to worse than where it was, because of house prices, shelter coming down, we still get in the high 2s in inflation by the middle of the year. So you can live with that. And it's part of why I think the Fed, if the momentum is moving in that direction to a more normalized state, although elevated from history, Fed can pause. But you made a critical point. The markets are pricing the Fed's going to start easing in 23. I don't think that's right at all. I think the Fed's going to sit with this for a while in a restrictive policy. Maybe in 24, 25, you'll start, not maybe, I think in 24, 25, you'll start normalizing rates back down again. But we're not going there yet.